Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend Podcast. Carol is on assignment today. This past week, some good news for equities as the U.S. and China reached a temporary truce in their trade war. Also, new inflation data indicated a more limited impact of tariffs, at least for now. In fact, we saw the stock market wipe out its losses for the year midweek. It also prompted U.S. President Donald Trump to, again, pressure Federal Reserve Chair Jerome Powell to lower interest rates. Yet cautious optimism lingers. We're going to dig into that a little bit later. Plus, the president's first official overseas visit, and to the Middle East. On the agenda, $1 trillion in deals, AI dreams, and one very shiny private jumbo jet. We break down the Trump administration's relationships with Middle East allies and where Israel stands. Plus, China's export restrictions of rare earths are in focus. We speak with the CEO of USA Rare Earth on bringing manufacturing of these strategic minerals stateside. All that to come. We begin, though, with a pulse check on the U.S. consumer. U.S. inflation rose by less than forecast in April. That led economists to fear that the real effect of tariffs lie in the months ahead. Retail sales decelerated notably in April, reflecting a consumer pullback on imported goods amid concerns about rising prices from tariffs. Walmart delivered another quarter of solid sales and earnings growth, but cautioned that tariffs and increasing economic turbulence means that even the world's largest retailer expects to raise prices. For the latest economic news, head on over to Bloomberg.com or check it out on the Bloomberg terminal. And that's exactly where we want to go right now. Let's bring in Dana Telsey. She's founder, CEO, and Chief Research Officer of Telsey Advisory Group. Her specialty, all things retail. Dana, I want to start with Walmart, even though this is not a company that you particularly follow. One of your colleagues does that. But the company did say that it is going to pass along costs to consumers. Not yet, but soon. We saw shares fall. How do you take the results that we got from the company in the context of what we know about tariffs and also the way that you've been talking about potentially empty shelves in the next couple of weeks?
A couple of things, and thank you very much for having me. First of all, if a company like Walmart, with the size and scale of Walmart, is going to raise prices because of the external environment out there, what does it say for all the others? So everyone, given the headwinds of rising costs that are out there, price increases are coming. However, it may be selective. It's not going to be across the board. It'll be, you can call it surgical, whatever word you want to use. It'll be surgical in what it is. But I've even heard, we have this price tracker where we've been tracking 80 items, and it comes out every Tuesday, same 80 items. And we have seen, of the 80 items we track, around 20% of them have had a price increase each week. And it changes. Sometimes there may be a promotion. Sometimes there's an event. But just on a tracker basis, price increases are coming. There's a reason why, in my mind, there has been some pull forward of sales.
The tracker, this is fascinating to me that you have this tracker. Is there rhyme or reason to the types of products that are being that are increasing in price?
Well, we track the same items every week, and they're legacy items, whether it's a pair of Levi's or it's a Barbie doll, whatever it may be. There isn't a rhyme or reason. But what's happening is that we expect, when we heard about these tariffs, we need a way to be able to track it. And so this way, look what Walmart just said, prices increases are coming. Let's see what this tracker shows in the next 4 weeks in terms of pricing. So it's very interesting.
You know, the difference that we're seeing in the soft data and the hard data, that consumers are saying that they're really pessimistic, but we're not necessarily seeing that yet in hard data or earnings reports. Do you agree with that thesis, or are you seeing pockets in some of these earnings reports that consumers are feeling the pain?
A little bit of each. When you think about where there's been a slowdown, luxury brands has been a slowdown. You take a look at the high end, LVMH reported a negative 3% same-store sales decline. That's typically weaker for an LVMH. You're seeing other companies that are brand leaders at not the luxury price points, but where there's brand leaders, where there's innovation, Look at the results that came out of Birkenstock. You had a high teen sales increase. You increased the guidance for the year on sales to the high end of the previous range, 17% plus, and you increased your adjusted EBITDA. What do they have? They have newness and innovation. At the same time, I met with Tapestry on Tuesday. I met with Levi's yesterday. Tapestry and Levi's and Birkenstock, heritage companies with authenticity that are reinventing their product. You know what they're doing? They're capturing a younger consumer. And companies like Coach, which is owned by Tapestry, a 15% increase in average unit retail selling price. Why? It's new and different.
Emily and I are smiling right now because on our editorial call, I said, we have to ask Dana about Birkenstock. Shares are up, 6%? You were on surveillance with Tom Keene and me last week. We asked you to name one company to watch. You said it was Birkenstock. You called this. Why are you bullish on Birkenstock? Because
their footwear overall has wide appeal. You have the flywheel of younger customers that are being attracted to the brand. It's not just open-toe sandals, it's closed-toed shoes also. You look at the expansion opportunities they have with their own stores. They only have around 10 stores in the US. They have wholesale accounts who have stores, but of their own. You take a look at Asia, which is a rising market for them. You look at the fact that they bring in goods, they're made in Europe. Yes, they have tariff exposure, but not the as significant tariff exposure. And look at their adjusted EBITDA margins. I mean, you're in excess of 31%. I don't have many companies that are generating mid to high teen sales increases with increasing EBITDA margins in an environment where there's uncertainty. But you're seeing it a little bit in footwear. You look at some of the other brands, Saucony, 30% increase in sales by Wolverine Worldwide. Merrell up in excess of 13%. So newness drives demand.
Yeah, Merrells are having a comeback. I've seen a couple Merrells on the streets of New York City. And that was like a shoe that I wore.
That's what I like to hear.
When I was like a child, but they're coming back. You know, Dana, I was looking at the S&P 500 sectors, the group levels. What was the top performing this year so far? What's the worst? Consumer staples is one of the best performing groups. Consumer discretionary is one of the worst. How are investors supposed to invest in the consumer space at large? How should they be thinking about kind of the direction of travel
when you
those
think
two
about
areas?
When you think about exactly the difference with staples and discretionary, staples is essentials. It's what you need, not what you want. And when you think about this environment where we don't know what the price increases are going to be, we've all seen the backward-looking data of consumer confidence, and so they're being careful. And so with staples, that's careful. With discretionary, it feels you have spending power. There's always the old adage that goes, when the stock market goes up, people feel great and spending can happen. When the stock market comes down, mind the hatchets, be careful. And so look what we've had over the past 2 months. That's what you've had. Companies in the consumer area are reporting first quarter earnings now. When you look at Walmart and what's to come, if they're saying prices are going up, that's going to be the mantra going forward.
We got to get you to weigh in on Dick's buying Foot Locker. What does it say to you? I mean, this is the end of an era for Foot Locker. This is a company that's been a public company since 1980. What does this M&A mean to you?
So overall on the M&A, where's the scale and where's the synergies? Foot Locker on its own is taking a long time to undergo this transformation, even under a well-recognized, well-respected CEO, Mary Dillon.
She came from Ulta, right?
Did great things at Ulta. Ed Stack, basically, legacy Dick's, his father founded it, Lauren Hobart. They basically reinvented what Dick's was with Dick's House of Sport. You talk to every real estate landlord, what do they all want? Dick's House of Sport. Why? Because it brings traffic. What's the difference between Dick's and Foot Locker? The customer base of Foot Locker, the 18 to 25-year-old guy. The customer base at Dick's could be more families. What do you get with both of it? And granted, the stock is down because the certainty of the execution at Dick's as Dick's alone was there. And you could basically see the path of growth with House of Sport. Putting it together, there's work to be done, transformation to be done with Foot Locker, gives them more buying power. Let's see what Dick's does, because what Ed Stack says is he's got the vision. He had the vision before with House of Sport. Let's see what he can do with Foot Locker.
Just 30 seconds. Sounds like you're optimistic. This is a good deal.
I think it's the valuation. Basically, it's six times and 17 times PE. It's not bad from that spectrum. What is it? Time length, and can you keep the focus on Dick's and Dick's House of Sport while you're integrating Foot Locker is the question go forward.
All right, Dana, appreciate you joining us from Talk Retail. Not a better voice out there. Dana Telsey, founder, CEO, Chief Research Officer of Telsey Advisory Group, joining us here in the Bloomberg Businessweek studio.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
President Trump this week toured the Middle East in his first scheduled overseas trip since taking office. Over 4 days, the president visited Saudi Arabia, the United Arab Emirates, and Qatar. He was there for one simple reason: to do business and make deals. And it appears to have worked. Saudi Arabia and the UAE unveiled commitments to increase investment with the U.S. by as much as $2 trillion over the next decade. In addition, Qatar Airways placed an order to give Boeing the single biggest deal in the U.S. plane maker's history. Not to mention the $400 million luxury jumbo jet the Qataris reportedly want to give the president as a temporary Air Force One. The strengthening of ties with Gulf nations have led some to raise alarm bells about the sphere of influence in the region. For more on U.S. relations with the Middle East and what this means for Israel and China, we caught up with Greg Roman, executive director of the independent nonprofit Middle East Forum.
Well, I think that what President Trump is looking for is partnership instead of ownership over the region. He expects that there be a quid pro quo between the United States and its trade, commercial, economic, and military relationships with Middle East allies. But there's also some sublayer here that I think the administration needs to be wary of, where in countries like Saudi Arabia and the United Arab Emirates are looking to foster closer relations with the U.S., with our businesses, with our markets. There's other countries like Turkey and Qatar, even though he's not potentially visiting Turkey unless there's that deal with Putin and Zelensky on Thursday, that are looking to influence the United States to outstretch their interests to the U.S.'s disadvantage. So there's two positive visits here and another one that I would be very aware of when he goes to Doha.
Greg, the president's saying, now there are our friends and our allies talking about Saudi Arabia. And I'm just curious, what does being friends and allies really look like going forward between the two? And where does that kind of leave the U.S. and its historical allies?
All right. Well, I think that Saudi Arabia and the United States have been historical allies since the meeting at Yalta.
But it's I guess every relationship's complicated, but it feels like this one's been a little bit more complicated.
Well, okay, let's go to 9/11 for a second.
Exactly.
After 9/11, and you had 14 years of animus between the United States and Saudi kings and princes because of their failure to own up to what was the resultant relationship of having cover for the bin Laden family. But Mohammed bin Salman becomes crown prince in 2015. He quickly starts to reform the kingdom, starts opening up its markets, asking for more investment in the United States, even goes so far as to invest money in an Israeli-led hedge fund. For the last decade, MBS has been at the forefront of trying to crystallize and closen relations between the United States and Saudi Arabia. The UAE, going back to the early 90s, has been in a close defense relationship with the United States since the Gulf War. But the third country that I mentioned, the Qataris, that's the one that I'm still wary of, considering the fact that they have huge influence operations and even espionage against members of the United States and also people who were even close to Trump's family.
Okay, so let's go there and give us exactly what you're concerned about, especially in the context of a potential gift of a presidential jet.
Well, I think this goes beyond the presidential jet. I understand why the Defense Department would try to have an interim solution for the lack of Boeing being able to deliver on Air Force One, which is now expected by 2029. But I think security considerations will put that aside, and the Secret Service won't sign off on that, even though I understand the token gesture. The larger issue is the $47 billion that Qataris have invested in American higher education, K through 12, businesses, our university systems, political lobbying to the tune of almost $78 million over the past few years, all with the intent of trying to buy both sides of the political aisle. And I don't think this is anything that really extends to the administration. But what the Qataris have done is try to create a white picket fence around their areas of influence on Republicans and Democrats, that whichever way American politics go, the Qataris will be there to win.
So why, I don't know, maybe this sounds naive. I mean, what is it that we need to be wary most when it comes to extending our relationship throughout the Middle East? I mean, we have relationships, right, with other countries, with other regions. There are investments that we encourage. We have a White House and president who is big time encouraging investments by everyone outside the United States into the United States. So what is it in particular at this moment in time, especially with a nation like Saudi Arabia that is trying to move beyond oil, right, and kind of extend its economy in different ways that does require maybe relationships beyond its borders. So I'm just curious, what do you think Americans need to be wary about in this relationship as it seems to be deepening?
I think with Plan 2030 under MBS in Saudi Arabia, the diversification of Saudi's economy, it being a key member of the IMEEC, the India, Middle East, Europe Economic Corridor, is great in terms of being able to have American companies invited to bid on infrastructure contracts there and to help them diversify it. It's a net gain for the U.S. and Saudi. Same thing with the Emiratis. They've placed their bet on AI. I think the fact they're willing to invest close to $1 trillion to this with Sheikh Tahnoon and his leadership through their ministries for infrastructure and development, it's a win-win for the United States. But the one that I'm worried about is wherein the UAE and Saudi Arabia don't have significant military relations with Iran, don't support Hamas, aren't actively supporting Syrian jihadis. That Qatari trip, the one in which you have a country which hosts one of the most egregious terror organizations to ever commit attacks against Americans, is one that I have to be very wary of, because I don't see what the net gain is for the United States. If anything, it's to our citizens' detriment to do any business with them.
We're speaking with Greg Roman, Executive Director of the Middle East Forum. He joins us from Los Angeles. Greg, I want to dig into what you described as an influence campaign of the Qatari government, specifically when it comes to higher education and indeed K through 12 here in the U.S. What can you tell us about what you found and what you've reported on, and really what the goals are of the government, of the country?
So if you think about all areas of American educational excellence, Carnegie Mellon in cyberspace, Northwestern in business, Cornell in medicine, Georgetown in diplomacy, Texas A&M in science and engineering, these are all places where the Qatari government has invested hundreds of millions, if not billions of dollars in bringing those campuses and the intellectual property and the professors to Doha. So if you look at the amount of students that study at Texas A&M Doha, it's Iranian students who more than anything constitute the people who are there studying nuclear engineering, physics, applied sciences. And they take that IP, which they wouldn't be able to access because they wouldn't get a visa to study in the United States, bring it back to Iran, and then contribute to their nuclear program. Even in K through 12, their goal is to try to create a generation of Americans who are sympathetic to Qatari foreign policy goals, so that maybe one person from a million who graduate from one of these universities ends up becoming president. The Qataris have their talents enshrined in them and are able to exert their influence on it. And we see this across business. Dozens of companies, hedge funds, investment funds, all taking Qatari money. And then when the right time comes, they use that investment and they activate it to have their influence.
So what do you make, or what do you believe is the significance of this being President Trump's first planned trip overseas? And you've also served as, I should point out, the political advisor to the Deputy Foreign Minister of Israel. You've worked for the Israeli Ministry of Defense. I mean, how do you think Israel and Prime Minister Netanyahu are looking at this trip?
I think that the U.S. is executing its own interests as much as we elect our president to be able to engage in policies that are pro-American. The Israeli government decides what's best for Israel. And more often than not, the policies mesh where there's a strong, close relationship between the two. But I think at the same time, President Trump is saying we have to have an America first policy. And that's not at juxtaposition where it's just against Israel's interests, but the net gain for the United States in terms of strengthening its relationship with Arab countries will also be a positive gain for Israel. We saw the same exact pattern take place in 2019 and in 2020 with the process that led to the Abraham Accords. And frankly, if I was Prime Minister Netanyahu, I'd be looking at the dialogue between Mohammed bin Salman and President Trump and seeing how close I am now today versus yesterday of having Saudi recognition of Israel and economic relations between the two heavyweights in the region.
I am curious, do we look back at this moment in time in 5 years, Greg, and say 3 years? I always think about this. Like, is this a moment in time where we are really strongly changing our geopolitical alliances? Or midterms or new president come 3.5 years or so, does that change things potentially again?
No, I think we're at an inflection point. The Abraham Accords was put on ice when President Biden came into office for other reasons, where he was trying to seek deeper relations with non-Arab Sunni countries and with Iran. But now we're basically picking up from where we were in September and October of 2020. More deals will be signed. Trade relationships will be deepened. We'll finally be able to have an alternative trade corridor to the Chinese Belt and Road policy, which has been going through China, Iran, Pakistan, Turkey, and onto Europe. And this is, I think, the reemergence of America as a viable competitor on the global stage with China, embracing our Gulf allies. And at the same time, it's also building closer connections between regional powers that for far too long haven't had the kind of relationship that they should have, whether it's trade, commerce, economy, or military. And President Trump is the glue that's helping cement all this together.
We have 30 seconds left. The president said he wants an Iran deal. He warns it to take the olive branch. Just 30 seconds on Iran while we have you.
Yeah, the Iranians are going to play President Trump along until they don't say that they're willing to dismantle their uranium enrichment infrastructure. I think we're going to get to a point where the Iranians are going to spit in the president's face. I understand why you have to try diplomacy, but at the end of the day, the only way for the Iranians to move forward is to eliminate their nuclear program, either by themselves or by an American strike.
Greg, 15 seconds. China. Is this all happening as the world, the U.S., increasingly is pushing back against China, and just very quickly?
Yeah, this is a global push against China. I think Europe and the United States have no daylight between them. And engaging the Gulf is pushing China out of the region, which is something the U.S. should have done for the last 5 years. It's a good thing it's happening now.
Greg Roman, thank you so much. Executive Director of the Middle East Forum, joining us from L.A.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Over the last 3 decades, Beijing has held an iron grip on the world's supply chain for rare earth elements, controlling nearly 60% of rare earth mining operations, more than 85% of processing capacity, and more than 90% of permanent magnet production. This is all according to the U.S. Department of Commerce. But with cooling tensions in the trade war, China issued export permits to U.S. buyers for these so-called rare earths. Removing these restrictions was a priority for U.S. negotiators because these elements are vital to high-tech and defense manufacturing. But even if the U.S. and China do reach an agreement on rare earths export restrictions, it's likely the U.S. can no longer be fully reliant just on China. One solution? Become a domestic supplier of rare earths. One company in the United States is working on this. It's USA Rare Earth. They're a roughly $840 million market cap magnet manufacturing company with facilities in Texas and Oklahoma. Joshua Ballard is the CEO of USA Rare Earth. I should note, we spoke to Joshua last month before the U.S. and China announced their tariff reprieve this week.
Well, it's affecting us in an interesting way. I mean, we're just getting started, right? We're building a large magnet facility out here in Oklahoma, where I am today. And for us, what it means is a lot of customers are calling, honestly, because there are few to none of these type of magnet facilities in the U.S. We're going to be the first and one of the largest domestic magnet facilities here. So we're getting a lot of phone calls, honestly.
So give us an idea of the time frame. Like, when is it up and running? What will you be
do you have anything to
selling?
sell them right now?
Yeah, no, today what we've done is we've commissioned a lab, so we're prototyping for customers. There's always a qualification process, even in at times like these. We're commissioning the plant. We're targeting the first quarter of next year. So we're a few months away, but we can at least start working with the customers, making the grade of magnets that they need, get them comfortable that we're capable, so we can hit production hard as soon as we commission.
What's going to be the output? Like, how much? I mean, we talk about this rare earths and magnets and what they go into and so on and so forth. So give us an idea of what's needed in the U.S. market and what you guys can ultimately supply.
So what's needed in the U.S. market, if you think about the global size of the magnet market today, it's probably around 250,000 or maybe up to 300,000 tons of magnets per year. In the U.S., outside of China, probably 2/3 of that is being used. And if you take the U.S. at 25-30%, we're maybe around 50,000 tons per magnets, 30 to 50,000 tons. Our facility itself, at our peak, will be building up to 5,000 tons. And to put that in perspective, 5,000 tons is hundreds of millions of magnets. I mean, it's a lot of magnets going out the door for everything from auto supply to EV manufacturing to drones and defense, everything across the board.
What will be the price of those magnets in comparison to what folks have been getting out of China?
Probably roughly double. So these tariffs are probably getting things into the realm of what we can manufacture here in the U.S. You have to realize, especially
pre-tariff, you're saying that pre-tariff it would be double? About double of what it was. No, I understand tariffs change the equation, but you're saying it'll be double the cost. Why is it more expensive here?
It's more expensive for a couple of reasons. One, it's just we have none of the supply chain here, so everything has to come from overseas. So you have a lot of extra logistical costs and profit being built into the supply chain as it gets here. And also, generally, our overheads and labor regulations and taxes are much higher here than they are in China, for example, just like it is with everything else. And all of that drives up costs. And we're just not as efficient. I mean, we have a lot to learn. We got to build these factories and really make them efficient here in the coming years so that we can start to really compete in the future.
Where are you sourcing the rare earths right now?
Right now, we're sourcing with our partners and good friends, Australia Strategic Minerals. They're working on a deposit in Australia, and they're sourcing out of Vietnam, Southeast Asia, and we make the metals in South Korea in order to bring them here to the U.S. We have no rare earth metal making here in the U.S. either, so we have to do it all overseas until we build up here.
Were you sourcing from China before the tensions earlier this year?
No, we were not.
So
we did this offtake agreement with them a couple of years ago, and they've been our partner since.
And what about when it comes to processing?
So when we think about our deposit, I mean, we're looking to build the first fully domestic rare earth supply chain here in the U.S. The processing in the U.S. is mostly sent over to China in order to process the minerals that we're getting out of the rock. We've been working on our own processing for our deposit over the last few years. So our plan is to process here in the U.S. and Texas on site at our deposit at Round Top Mountain, which is near El Paso in West Texas.
Josh, forgive me if I sound, we're all learning about rare earths, who, as we joke, not so rare, but, you find them in small quantities, so it takes a while to get them out and so on and so forth. But when you say processing, is that the same as mining of what you're going to be doing, or the processing that is currently in China that actually makes it all usable?
Yeah. The processing is the science to get the minerals out of the rock. So rare earths are not like coal, where you go in, you have a big vein of coal and you can just dig it out and use it. Rare earths are actually they're in the rock, and they're in maybe 50 parts per million or 100 parts per million or 500 parts per million. You have to actually use science engineering to pull and leach out those minerals from the rock itself in order to process it to create the ore oxides that you use to make metals. So there's an entire science and engineering outside of the mine itself, which is basically digging, breaking up rock, crushing it, and leaching it in order to get the minerals. So there's a whole science to it, which right now China has control.
You mentioned Round Top outside of El Paso. What is the goal for getting this online? Because my understanding is that in order to process here in the U.S., we're still years away from seeing that.
Yeah, and we're a few years away too. I mean, our goal here at USA Rare Earth is to build our initial pilot plant over the next couple of years. We're getting through the science of it. We're pretty comfortable on where we're headed. Like many of us, we had dark corners running into walls a few years ago, as you try to figure out the science around this processing. We made a lot of great progress, so we're starting to push forward towards a pilot plant here over the next couple of years. And from there, we would build the full mine and processing facilities in Texas. So we're a few years away, but not as far as if you look at Greenland or Ukraine that we've been talking about a lot in the news in the past months. They're decades away. We're talking about a few years.
So let me clarify. So the magnet facility that you talk about in the first quarter of next year, that's going to actually be providing product or not yet?
It will absolutely. Yeah, the magnet facility will go online.
Okay.
Ultimately, we want our feedstock to come from that deposit in West Texas. But as we start, we're going to have to get feedstock from overseas, which for us is going to be South Korea, specifically working with KSM and other partners.
So the feedstock is what you're saying is going to take a couple of years to get to.
Yeah, through our deposit. Yeah. To have that fully integrated supply chain.
Why haven't we done this in the U.S.? If this was so important, why hasn't this happened sooner rather than later?
Yeah, it's a great question. And the reason why it hasn't, if you go back 30, 40 years, early 90s, there was a vice premier in China who said, the Middle East has oil, China has rare earths, right? They had a strategy around this for years, and they've been very successful at it, at building a very strong supply chain in China, which we gave up on. They did it more effectively. They did it cheaper. We've known this for years. None of what's happening today is a surprise to any of us in the industry. This was bound to happen. We had one choke point in China that can, and these heavy rare earths that they focused on, this export control, they control over 98% of it. I mean, they chose these minerals for a specific reason, to say nothing for the fact that they're used in industries such as defense, where we really need them. And so we walked away from it. We were addicted to low cost. We heard from customers prior to all this as well that, well, you can't do it as cheap as China. Maybe we won't do it. Now suddenly we're getting phone calls again as people realize the value of the risk in having a supply chain completely contingent on one choke point.
Yeah, it's interesting that the U.S. is just realizing this, given that this kind of happened to Japan, 15 years ago or so with that territorial dispute with, I think, fishing. So now Japan keeps like this 1 year supply of some of these rare earths because they didn't want to be at the whim of another country. What do investors need to understand about your company? Because correct me if I'm wrong, but my understanding is you were originally focused on rare earths in particular, but then you've pivoted to becoming a magnet manufacturer. What's the distinction there?
The distinction is magnet manufacturing, first of all, is an execution story. So we're building a plant. We know how to build the plant. We know how to build magnets. We just need to produce good quality product for our customers. So that's all about execution. It's a near-term event that'll occur early next year, and then we're going to scale up as quickly as we can after that, up to our 5,000 tons per year. So it's a near-term story. The deposit, and I should say too, on the magnet facility is we're going to be the first really and largest diversified facility to focus on the broader market. So there are other magnet facilities in the U.S. today and our peers, but they've been bought by auto manufacturers and are really bespoke for an auto manufacturer. We're really looking to focus on the broader market, which is unique today in the market, and we'll be one of the only ones, one of the first.
Josh, if tensions ease between the United States and China and tariffs are not as onerous as we are seeing today, what does that do to your mission? Does it back off, especially if all of a sudden imports from China in rare earths and magnets are less expensive?
I don't think it backs off. I think the world has certainly woken up to the risk inherent in the supply chain. We were already getting interest before this. I think it's heightened now, obviously, with tariffs and everything else. So maybe the full supply chain wouldn't move over right away. We don't need the full supply chain. I'd be happy with 10% or so. But there's still that risk has been heightened. People understand it. There's a cost to that risk. They have to diversify. They need to do it domestically. And the patriotic play is important today. And I think companies are going to want to talk about that. We had our first announcement today with a great smaller customer, great customer who wants it for the patriotic play, right? They were talking to us well before these tariffs came out.
All right. Going to leave it there. Hey, listen, thank you so much. Really appreciate it. Joshua Ballard, he's CEO of U.S. Rare Earth. It's about an $840 million market cap company, magnet manufacturing company. We heard more of their mission.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek, including President Donald Trump's cryptocurrency and the mystery investors vying for seats at an upcoming dinner to promote the meme coin. Plus, former Washington governor, and yes, a Democrat, Jay Inslee has a way to win over young Trump voters. We'll explain. First up this hour, though, two things certainly top of mind for investors: investing in Europe and investing in AI. Earlier this month, Carol attended the Principal Asset Management Real Estate Investor Conference in Paradise Valley, Arizona. It was a gathering of experts in the industry who gave their perspectives on the macro environment, investment themes, and more. One theme that's certainly on the minds of many real estate investors is that of global opportunities, and particularly whether U.S. policy is pushing investment outside of the U.S. and instead into other regions, such as Europe. Tim Hill is Senior Executive Managing Director for U.S. and European clients at Principal Asset Management. He joined Carol in Arizona.
Yeah, our experience in the UK in particular, I would say right since the Liberation Day has been, quite frankly, keep calm and carry on. And again, I think it's proven out here. We've seen it in the markets overall. I think from a real estate perspective, we continue to see great interest in the strategies that we have. In particular, I think because we're a little bit more specialized, data centers, particularly in Europe, very attractive. Student housing be another area that we're looking at as well, too. And we actually have seen across Europe some interest in our U.S. strategies as well, too. And I think that from our perspective is a pleasant surprise. And today's announcement, I think, only served to sort of, put a foundation underneath that.
I'm guessing you're talking, Tim, to clients on a daily basis. I am just curious what you're hearing. Are they all kind of like, okay, we're going to wait and see where the dust settles? I know long-term, or, when you're thinking about real estate, it's a longer-term investment play, right? So you're not necessarily in and out. But I'm just curious, what's kind of the mood, the narrative that you're hearing from them?
Yeah, I mean, you're exactly right. 100% we're basically, wait and see. I think a lot of places are...
Even through the month of, April, where it was so volatile, still wait and see?
I would say what was more volatile was the conversations. The first 15 minutes of every discussion with the client was quite intense, particularly I think in Europe. The U.S. doesn't hold a monopoly on chaotic governments. And so whether you're in London or Madrid or Paris, they've all had their own challenges, and they're just trying to get a better understanding. For us, you just had SEMA on. The demand for our macro and our insights has risen dramatically in the month of April. And so having that type of content out there really helps them, our clients, to check what they're thinking and how they're planning for their portfolios.
Tim, I love that you said that like other governments have had their own problems. And I think for we as Americans, this is unusual for us. Yeah. The level of volatility and just kind of a different type of administration. Some say maybe that's what the country needs. Some say no. But that perspective of what you're hearing from European investors, is there a lesson or kind of some, advice in terms of what we are going through as investors here in the United States?
Yeah, I think so. For me, I started working with the teams in Europe about 3 years ago. So I'm a Midwest born and raised, and so it's been a great experience. But I think a lot of it is they are not afraid to laugh at themselves and sort of absorb the situation. And so I think there are some lessons to take away. We don't, I think, spend a lot of time laughing at the situation or trying to appreciate what's going on or the other side's view. And, again, I think the first morning after Liberation Day, I was sitting in London, having a conversation with clients back and forth. It was interesting, but, there was no sharp elbows that have come out since then. And, again, clients are still looking to keep their allocations. They're not moving money away. But I will say there's buoyed confidence, I believe, across Europe in terms of what that means going forward.
Is there a market that you think would surprise investors, especially when it comes to real estate, that maybe isn't being talked about a lot, that is all of a sudden gaining some attention, or at least clients are asking about it?
Yeah, I think it's, again, less market, and it's more what asset class within real estate. I think it's not only real estate, but also infrastructure. Infrastructure is really big, and it doesn't matter whether we're talking institutions or you're talking in Europe at the global financial institutions, private banks. That's a big spot where we're seeing a lot of interest as well.
It's interesting at Milken, I think it was George Roberts of KKR, iconic, was talking about infrastructure. And I know they have been, I think, beefing up some of their efforts in that area. But it's like all of a sudden people are talking about that play in all its different forms.
Yeah, I think it's unique because it matches up for a number of institutional clients, insurance companies, and then for public pensions, the LDI space, where you're looking for more long-dated paper to be able to match up with those liabilities. And the fact of the matter is, when you look at the public fixed income markets, you tend to have a very narrow list of big issuers. And so from a diversification perspective, infrastructure is really interesting.
What are clients asking for in terms of different strategies to play the real estate market? Are they comfortable with the products that are out there? Are they looking for something different at this point?
I would say, the core space has been challenging the last couple of years, and pretty much
post-pandemic, still dealing with some stuff.
Correct, hangover from that perspective. Going into the end of Q1, we were starting to see some really good interest coming back into that. Indications of interest, RFIs that we're putting out there. Into the first 2 weeks of April, that just ground to a halt. And now all of a sudden here we are 30, 40 days later, and we're right back into those same conversations again. So I think it's a pretty broad-based interest.
I want to go back to kind of how we started. We've just got about 30, 40 seconds left here, Tim. But I mean, you guys have been doing this for, I think, 25 years. You've been involved with the bulk of them. In terms of this moment in time when it comes to real estate investing, how do you think about it? How is it different in comparison maybe to other cycles?
Yeah, I mean, we had a deep dive on stage this morning talking about the different cycles, whether it's a savings and loan or the GFC. We don't think we're anywhere near that type of depth of concern and where we sit in a really great spot. And in terms of returns that we've had since the pandemic, they're really not that bad and really put us in a position to take a step forward.
Why does it feel so bad? 20 seconds.
Yeah, I don't know.
People blame the media that we talk too much about it, but I'm just curious.
I think there's a perception that where interest rates are at, that things are dead from that perspective, and quite frankly, that's not the case. If we take a look over time, there's correlation there as well.
This was fun. Thank you so much.
Awesome.
Really
Glad to be here.
Tim Hill, Senior Executive Managing Director, U.S. and Europe, Client Group over at Principal.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We stay in Arizona for another conversation, this time discussing real estate infrastructure, and more specifically, the macro tailwinds leading to more infrastructure development. Things like decarbonization, prompting a more modern electrical grid, and the boom in AI bringing about the growth in data center development. Mansi Patel is Senior Managing Director and Head of Infrastructure Debt at Principal Asset Management. She joined Carol in Arizona.
It's certainly an exciting time for the sector and the space. I've been in the project finance infrastructure markets for over 2 decades, and the momentum just in the last year and 2 years is incredible, both from macro tailwinds of decarbonization, digitalization, demographics, all those shifts creating this natural need, tied with exactly what you described on high interest rate environments that create opportunity sets for investors and clients. When you think about the macro need, there's a statistic out there of 90 trillion of investment needs over the next 15 years.
Right.
Of that, about 15 trillion of a funding gap. So it's really an incredible time, and all the tailwinds are supporting that growth.
I love this, and I want to ask you, I want to kind of dig into some of what you said. You know, we have a Going Private newsletter, and it said, money managers rush to invest in the world's essential plumbing. And it talked about alt investors, alternative investors. They want in on infrastructure. When you talk about the decarbonization, I think, again, we get kind of this American perspective, U.S. perspective, because of some of the policies coming out of the White House, that's it in terms of the green environment.
Sure.
But that's not the case globally, is it?
No, I think you're right. I think there's just this natural competitive dynamic of renewable generation and energy transition, and even natural gas being part of the energy transition thesis. And so it's midstreams, it's pipelines, it's gas generation, it's renewable power, it's batteries. It's sort of all of that together to really modernize the energy and electric grids globally.
Right.
And then also an interest in doing good and in sort of creating a macro environment to support broader policies. And so I think there's a lot of activity in energy and renewables and other sectors, but that's certainly a theme that hasn't slowed down.
Right.
Because there's a natural need.
Well, especially when you think about the AI data centers.
Exactly.
I mean, people are talking about nuclear again, right?
That's right.
In a way that we haven't heard in terms of for years. You guys actually did your own research, the Infrastructure Investors LP Perspective Study for 2025. It's an annual barometer of investor confidence. Talk to us about some of the findings of that research.
Yeah, it's interesting. Infrastructure tends to be a safe haven a bit from an investor lens, right? It's hard assets, it's collateralized, it's deals that are essential to local economies. It moves people, it moves goods, water, utility. Think of sort of core infrastructure that drives economies. And I think there's just a continued interest in the sector because of the growth in the need and the safe havenness of these assets, because it's driven by stable, predictable cash flows. You continue to need airports, you continue to need ports, roads, and it's been proven through the GFC, through the COVID pandemic, the resiliency of the sector really has shined through.
And the money's going to be there? I mean, it's the investment base, it's also governments committing more money to this, aren't they?
That's right. Yeah, I mentioned the 90 trillion number of that. When we calculate the funding gap, it's about $15 trillion of private sector needs.
Right.
And so with the combination of public sector and private sector growth, that should fill that gap.
How much is the global supply chain, the conversations we are having so often today, obviously the news that comes out of the White House in terms of tariffs and trades, but I also think it really started back after the global pandemic where people were like, wait a minute, our exposure, we've got to kind of broaden out so that we're not so vulnerable. So tell us a little bit about pandemic, but then kind of how that has continued.
Yeah, no, I think it's a sector that's viewed to be recession resilient and economic cycle resilient. It's because of what we just talked about in terms of essential assets and the flow of cash. So I think that trend has not slowed down. Away from seaports, which are impacted certainly by global trade, all other sectors are pretty resilient and self-sustaining within their geographic location. So we don't see a dramatic impact. Greenfield and development phase assets certainly could have some impact to cost. But beyond that, the resiliency of operating assets is quite remarkable.
But is there expected, Mansi, that there's going to be an additional build of people? You know, obviously President Trump talks so much about, the investment coming into the United States. Do you guys really expect, as, talk to Apple? I mean, they slowly were doing things, it sounds like, in India, and all of a sudden they're like, hey, we can supply all the iPhones you need in the United States out of India. Like, it felt like it came out of nowhere, but they've obviously been doing this. But the builds are not easy. It's not like you flip a switch. So do you guys anticipate that will be part of the real estate play going forward because people are doing redundant global supply chains, although that's costly for a company.
It is. I think there is a blend for both. There's a world where you do have onshoring, and there's a world where you do need both. And so we do feel optimistic. You're absolutely right. It's going to take multiple years and decades for the scale of some of these assets to actually get developed. But that theme is there, and the trend is there. So we think, and that's across the world, right? Not just here. And so I do think that creates growth and momentum, but it's going to shift a little bit of where capital flows go.
Talk to us a little bit about the finance and capital structure that we're seeing in infrastructure deals today. What do they look like?
Yeah, it's a great question. It's become a very creative subsector, I would say, in the sense of clients and private credit more broadly, right? You've got...
I knew you were going to go to private credit, because anytime it's creative, it's private credit.
There's investment grade, traditional long duration, insurance capital, right? That's the bread and butter of infrastructure. And then there's the high yield infrastructure universe, where there's creativity in terms of subordination solutions on core infrastructure, or more technology risk perhaps, or development risk perhaps. So there is a place for every client appetite, in my opinion. Depending on duration needs and target yields, we can create very bespoke, customized solutions. So,
when it comes to, I keep asking all of your team, not 6 to 12 months, because real estate is just such a longer play. Yeah. I mean, it sounds like there's optimism, first of all, right? Despite the concerns and the volatility that we've seen, it sounds like when it comes to real estate, it's a lot more calmer. Maybe it is because of those longer term plays. And when you're dealing with private credit or private money, right, those investments kind of don't move in and out so much.
There is a little bit more resilience and stickiness to investment thesis, and you're investing into the long duration of these assets. So you're absolutely right. The short-term volatility, there is just fluidity in that you can pause and you can step back and evaluate, but that doesn't slow down the activity. Anytime there's public market disruption, that tends to help in terms of private sector.
You said you started, and I like to kind of go back, is that you've been doing this for a while, and I love folks that have seen different cycles. How are you thinking about this cycle when it comes to real estate?
Yeah, I think it's from an infrastructure real estate lens.
Infrastructure, particularly.
Yeah. From my lens, it's a really incredible time. You mentioned the comments at Milken. I think the growth is there, the need is there, it's essential, and the capital is eager and excited. So it's really the stars aligning for the sector. That's part of the reason Principal has made such a concerted effort into building out this capability and augment what we are already doing in private debt in a meaningful way. So I think that theme continues, and it is quite positive and exciting, I think, in the realm of everything else going on.
And I think it's safe to say that when it comes to infrastructure, I mean, there are just projects that just need to be done.
Exactly. Yes, there's roads that need CapEx. There is power needs with the data center build-outs in the country. There's just very critical, essential needs. Anybody driving or flying in this country is appreciative of the capital expenses needed to upgrade some of the infrastructure.
It's funny that you say that. I think about going through the airports now, certainly in the New York metro area, and it's just for so long that it was just so terrible. And then all of a sudden you're like, well, wait a minute. Yes. It's finally happening.
Yes.
And it's really great stuff. Nancy, thank you so much. Really appreciate it.
Thank you for having me.
Yeah, thank you for actually hosting us. We really appreciate it. Nancy Patel, Senior Managing Director, Head of Infrastructure Debt at Principal Asset Management here at the Principal Real Estate Conference in Arizona.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
On Monday, Coinbase, the largest crypto exchange in the U.S., will finally get a seat at Wall Street's main table when it officially joins the S&P 500. That announcement this past week led its stock to soar as much as 26% in a single day. Coinbase CEO Brian Armstrong on Bloomberg TV this week reacted to the news.
It means that crypto is here to stay. People are going to have crypto exposure in all their 401ks, and it points a little bit to, I think, where the future of financial services is going. Crypto is a technology to update the financial system, so it's a great moment.
That was Coinbase CEO Brian Armstrong. We should note, too, that this past Thursday, the New York Times reported that Coinbase is cooperating with the U.S. SEC on an agency probe into its previously reported user metrics. Meanwhile, Bloomberg reported that hackers had near constant access to some of Coinbase's most valuable customer data since January. Coinbase disclosed that hackers bribed customer representatives to steal the data and then demanded a $20 million ransom to delete it. Check out the latest on this story on the Bloomberg terminal and at Bloomberg.com. Meantime, Robinhood agreed to acquire crypto platform operator WonderFi. Morgan Stanley's digital asset markets head is leaving the bank to start his own crypto and digital asset investment fund. Oh, and the president is hosting a private dinner on Thursday to promote his Trump meme coin. Needless to say, there is a lot going on in the world of crypto. We broke down Coinbase and the presidential crypto dinner with Bloomberg News investigations reporter Anthony Cormier and Bloomberg News senior editor and crypto payments team leader Mike Regan.
In some ways, it was sort of inevitable that Coinbase would get added to the S&P 500. If you look at its market cap before the announcement, something like $53 billion. I mean, that's puts it in the top half of S&P 500 stocks by market value. I think what kept it out for a while is that Coinbase's earnings can be very volatile. Post a loss some quarters, big profit some quarters, smaller profit the other quarter. So one of the S&P 500 criterium, I guess is the word, is consistent profitability. You know, they want them to be profitable in the last quarter, and they want the trailing 4 quarters to be profitable for a company. So, you know, there is sort of this rumblings you hear that they got snubbed in the last S&P 500 reconstitution, but I think it was more likely, and we never hear exactly what the S&P committee, how they make their decision. But I think they were probably more worried about that earnings volatility than anything else. You know, that said, it is obviously a much friendlier regulatory environment for Coinbase. So a lot of those questions about the case with the SEC have sort of been washed away.
Great. Yeah. Speaking of the friendlier regulatory environment, that was the segue I wanted to use.
Well, go.
Okay. Well, speaking of the friendlier regulatory environment, I want to bring in Anthony Cormier because he's been doing some reporting around the Trump meme coin. The top Trump crypto buyers who've been vying for dinner seats. This dinner is happening supposedly on May 22nd. You and the team dug into the wallets, did some digging, found some details about who these folks are, and it's actually not very clear.
No, we know less now than when we started.
But you did find out a lot.
We did go hand by hand. We did one by one through the 20.
Wait, lack of transparency on someone who's doing something in the crypto world? Holy moly!
Well, just to set it up, this is the dinner that is happening on May 22nd. It's going to be with the president at his Virginia Golf Club.
Yep.
And the top holders of his meme coin over a certain period of time would gain access to the dinner.
Top 25 get to meet him in person, get a special VIP tour. 220 get to have dinner with him in Sterling, Virginia. And as you said earlier, it is quite difficult to know who or what are behind some of these wallets. So we went one by one and learned what we could. And that was that more than half of them are likely foreign. 6 of the top 25 are almost certainly acquired their shares from an exchange that doesn't allow Americans to acquire them. And before I walked in this room, I was going through Twitter looking for all of the people who have posted their invites online to see what we could learn.
What's the law on that? And the reason I bring that up is I think about all of us who go through training, who work at U.S. companies. We go through extensive training about who you do business with. If you're, a business deal, a contractor, you've got to know exactly who they are, where the money's coming from. And if there's any questions, you don't do it.
Banks do KYC all the time. They know your customer stuff. There's anti-money laundering programs. Now, in fairness to the president and the meme coin operators, they are saying that you have to go through certain steps. We don't know what those steps are, right? In order to get to this dinner, that we don't know what, to quote, KYC watch list you have to avoid to be in this dinner. All of those questions we've posed to the White House, they've thus far refused to answer.
Mike, how are you looking at this as somebody who's covered markets for years? You're now heading up you're senior editor, and you're also heading up the crypto team. There's this idea now that the idea of appearance of conflict of interest, has kind of been thrown out the window at this point. It's a question that I asked Eric Trump about when I interviewed him a few weeks ago. And he basically said, you don't have to worry about this. I never talked to my dad about crypto and crypto policy. But the president does have a hand. He makes money when certain things happen.
Yeah, I mean, I guess gobsmacked is the word I would have in just how brazen it really is. And some of the prominent Democrats are screaming from the hilltops, Elizabeth Warren and others, not only about this, but World Liberty Financial, Trump's other crypto project, introduced a stable coin, a crypto token that's pegged to the dollar. It was just used in a $2 billion equity stake from a Dubai fund into Binance, which, if you recall, was the crypto exchange that just 2 years ago, less than 2 years ago, settled some very major charges with the U.S. Justice Department about basically not having an not having that KYC program in place that Anthony's talking about, or an anti-money laundering system in place, or at least not a robust enough one to catch what the government alleged was, terrorists and all sorts of criminals using that exchange to launder money. So, it's just shocking to see that, what you thought were sort of checks and balances in the government don't really matter if the controlling party is on board with the president and willing to give him this type of latitude.
Where's the financial community? There are everybody and anybody in terms of the financial might globally, certainly in the United States, trillions of dollars, right, worth of capital, assets under management. In the past, crypto has been a topic. But I got to tell you, we talked infrastructure, we talked supply chains, we talked tariffs, we talked private markets, and we talked democratization of things like private credit. Mm-hmm. I think we had one interview with someone who's definitely into crypto in a big way, but it wasn't a big thing. So where is the financial might and the folks on Wall Street and the big investors? Because who's doing all the activity? Why is crypto, is it just the White House?
No, if you look at especially the SPAC deals being priced recently and being announced, Cantor Fitzgerald, one of their SPACs is teaming up to create basically a company whose main purpose is just to buy Bitcoin and keep it on its balance
Nothing
sheet.
can go wrong with the SPAC.
Right, exactly.
I'm just saying, I know there's ETFs and so on and so forth, but I'm just trying to get an idea of the buy-in. Where it's all coming from.
I couldn't speak to institutionals, but doesn't Coinbase now making the S&P, doesn't that expose my 401k to crypto for the first time? I mean, I think that's a really interesting sort of context right here, where there's it feels like a pivotal moment, right? If I'm a consumer and I don't want to take that risk, now all of a sudden I don't
have a choice.
I don't have a choice, right? Exactly. I think that's really a kind of key moment, right?
I agree with you. I looked at it like that as well. Anthony, I want to go back to this idea of the dinner, because with the digging that you did into these wallets and you had them, you looked at different exchanges, you tried to identify folks. You said as you were walking in here, you're actually looking on Twitter to see who's posted invitations. Right. What have you found that's not in this piece? What have you reported on over the last few days, and what have you seen?
Well, we're trying to figure out who is going to actually do the vetting of these people. And we're really keen to know whether this is happening on the Trump private end or the Secret Service end. I think it's a really vital question. The Secret Service is going to have a much different standard potentially than the White House.
Well, when you say vetting perspective, do you mean from a safety perspective, the background checks? I mean, getting physically close to the president, and especially somebody who's been the target of not one but two assassination attempts over the last year, I would imagine the Secret Service is very, very serious about keeping him protected.
You would think so, but I think the real concern is going to be on the anti-money laundering front, right? How much can you know about some of the operators who have bought their way into a personal meeting with the president? And I don't believe the Secret Service has the kind of tools that someone like FinCEN would in order to understand who's a bad actor and who's not. So I'm curious to know quite a bit more about that.
Yeah, I've seen one of the invitations to the event, and they are, you're going to get searched. Your vehicle's going to get searched. So I'm sure, what is under the control of the Secret Service, to your point, is, they're going to do their best to protect the president. But you're right, though. It's hard.
But the vetting often starts. I've gone to the White House, and they needed stuff up front before I even stepped on ground. So you do wonder about what kind of real vetting can they do before they even walk in?
When I reported on the first Trump administration, I had to send my social security number to the White House, perhaps to the Secret Service, before I even went to the White House.
Yeah. We don't know if that's the case.
Wow.
We truly don't know.
So, Mike, I love what Anthony said about, okay, guys, democratization, y'all now own some crypto, whether you like it or not. That is an important turning point and kind of legitimate turning point, if you will, it feels like, for crypto.
Yeah, definitely.
Or TBD to see.
Yeah, I mean, it's been, one of a series of sort of events that have further legitimized and brought it more mainstream. I won't comment on whether or not that's a great idea for all of our 401ks, but like it or not, here it is. Coinbase is not only a respectable company, a top, they're in the top half of market cap in the S&P 500. And I don't think, it's not the beginning of the crypto exposure for sure in sort of passive index funds. Tesla owns some crypto. If you look at MicroStrategy, which is one of these companies that a lot of these SPACs are just trying to emulate, that is already in the NASDAQ 100. So if you own that QQQ index, you own a chunk of that too.
There are a lot of companies that have been out there that have had some really big market caps that have gotten, I don't know, I guess time will tell on all of this.
Yeah.
But we'll wait. Mike Regan, Anthony Cormier, thank you guys so much. What a great chat. You're listening and watching Bloomberg Businessweek Daily.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
All right. I do want to point out, everybody, just a little bit of a backdrop. 2 U.S. science organizations are launching a new climate research initiative after the Trump administration dismissed expert authors of the National Climate Assessment. Now, the initiative will publish peer-reviewed manuscripts on climate change in the U.S., aiming to create a library of information for government, academia, philanthropy, and business. The effort coming after the Trump administration terminated the contract for staff working on the 6th National Climate Assessment, which was expected to be released next year. We know that there's been a lot of moves, pushback when it comes to green initiatives out of the Trump administration. Our next guest, I'm assuming, will have some thoughts on all of this. Joining us is Jay Inslee, former 3-term governor of the state of Washington, former member of the U.S. Congress, a 2020 Democratic presidential candidate, winner of 2025 Time Earth Award, and he's also leading the accountability project at the policy and lobbying group Climate Power. And he joins us from Bainbridge Island, Washington. Great to have you here with us, Governor Inslee. Thank you. Thank you.
Thank you. Appreciate your attention to this topic.
Well, there's a lot I want to talk to you about because I feel like you are someone who has seen lots of political and economic cycles in the United States. And before we get into jobs and green initiatives and green jobs in particular, the U.S.-China relationship, how do you see it? How important is it? And how do you assume it will ultimately have to play out because these are the 2 largest U.S. economies and they're intertwined?
Well, obviously, there's not much debate about how important this relationship is. And we're all very disturbed and concerned about the president's desire to make life more difficult for Americans by forcing them to pay the Trump tariff tax, which we know Americans will have to pay if he is successful of imposing these large tariffs. We are all pleased this morning that some news that Trump is already sort of giving up on this ruinous tariff of 145%. That's good news, but we shouldn't give him the Nobel Peace Prize because it's like the arsonist is starting a fire and then he wants credit for being the fire person to put the fire out. He started this fire. We hope it gets put out and that we have more reasonable trade relationships on a reasonable basis. Well, we hope that that'll be the case. But it hasn't borne out yet. Having
said that, I think both Democrats and Republicans for several years now, and if you think about through the Biden administration, some of the tariffs imposed on China were certainly continued through the Biden White House, that most on both sides of the political aisle have agreed that the relationship between U.S. and China maybe wasn't a fair one. It wasn't balanced. And so something had to change, especially as China's economic might has changed and grown.
Well, listen, there are some reasonable things you can do, and then you can do absolute ruinous things as throwing a grenade into a relationship. And Trump threw a grenade, and, 145% tariffs means that Americans are going to pay double for products that they're buying from China, and that's a significant thing. And it's already caused a job loss in my state because we're down, no ships coming in, no longshoreman jobs, no trucking jobs itself. So yes, there's always a spectrum of action, but I think that what he has proposed would be really ruinous for Americans. Hopefully this will get resolved, that he'll start to see pressure from bond markets as he did the other day, and that this will restrain his madness. We hope that we will be successful in that regard.
I have a little bit of a curveball here, if I may digress for a moment.
Governor. Get ready.
And, well, I don't know how you're going to answer this, because Washington State, I don't believe you have an income tax, right? You made me think about the arson putting out the fire. You made me think about the SALT deduction, right? Because President Trump and the Republicans capped the SALT deduction that had been American tax policy for over 100 years in 2017 with the TCJA. And now there's a question about whether or not it survives or in what form it does. I wonder what you think about that as a state, as a former governor of a state that doesn't have an income tax. Does it seem fair to allow state and local taxes to be deducted? Does it avoid double taxation, or do you think that we should have a cap?
It's something I haven't really thought that much about. It's one of those things that when you have a disaster looming, you pay less attention to your parochial issues. I will just say I hope it gets worked out. I will say that. And I hope that we don't end up killing clean energy jobs just to finance tax cuts for the rich. That's the thing that I'm focused on. More parochial issues, to me, are subordinate. And the national economic climate is so at risk right now. That's what I think we got to pay attention to.
All right, so let's go there, because your team did share with us a report from Climate Power. You work with them, and it talks about clean energy jobs in particular created and those that might be clawed back as a result of President Trump's policies, executive actions, tariffs, and more. I will say, coming off of Milken and some of the discussions that I had with folks when it comes to clean energy, green energy, in terms of investing, many said it's going to continue because if you're a global company, you have to think about it on a global level. You have to think about it beyond a 4-year presidential term. And, just companies in many ways, their initiatives will continue going forward. But what's important about this report? What do you think our Bloomberg audience needs to know?
Well, what I think the audience needs to know is that we ought to be very optimistic about the clean energy economy. The growth is spectacular. And the reason is technology is advancing at such a rapid clip. The cost of solar energy has come down 40% in the last 10 years. Wind continues to come down. We have 10 times as much installation as we did 10 years ago. So the rate of the reindustrialization of America through renewable energy is quite profound. But unfortunately, the president, because he has this phobia or mania, he says wind turbines cause cancer, which is just nuts. It just caused jobs all over America. And that ideological fixation has already cost us or jeopardized 62,000 jobs in the United States, which is a spectacular way to shoot yourself in the foot. And the thing that's so disappointing to his multiple efforts, these are multiple efforts. He threw 1,500 people out of work who were building an offshore wind turbines off the East Coast with 24 hours notice. And he's doing that by refusing to permit these clean energy sources, by attacking the tax policies that allows these industrial jobs to be created. It's just really killing the number one job creator in the country right now is clean energy. So that's really threatening this engine of growth. And it doesn't make any sense whatsoever. Here's the thing that's so frustrating to me. He talks about he wants energy dominance. Well, if you want energy dominance, you shouldn't sideline some of your best athletes, which are folks building the clean energy economy. And so it's very disturbing, and I hope Congress will stop some of his maniac activities to hurt jobs in this country. 62,000 jobs, a lot of job loss.
Well, what about
it right in my state?
A reshoring of manufacturing jobs? Is that not something that you could be optimistic about, that you think might benefit, the people of Washington State, the people of the United States of America?
Well, there's two separate issues here. I think it's important to keep them distinct. There's the tariff issue that you're thinking of that potentially could get some reshoring. If that someday could happen, that would be a fine thing. What I'm referring to is efforts to basically kneecap these new industries in a dozen different ways, starting by literally shutting down the development and construction of these projects, like offshore wind, like his refusal to give permits for solar powers, like his effort to kneecap the Bonneville Power Administration, which is the group charged with the responsibility of building transmission lines so we can build these new energy generating capacity. Like telling the Pacific Coast we're not going to be able to move forward with offshore wind. So these are two separate issues. And what I'm addressing are the facial attacks on the policies that we know do grow these jobs domestically, including the tax cuts, which he and the Republicans are threatening right now, to stop the tax breaks to allow these industries to grow, just to give it folks to tax cuts for the wealthiest folks amongst us. And that's probably one of the most dangerous things going on right now.
Governor Inslee, just got about a minute left here. I mean, what we often find, in terms of coverage of global financial markets is that money tends to go where it makes sense. And ultimately, do you have enough faith?
True.
No, it just in terms of, if investors can make money, they're going to go there. If it makes sense, investors will continue to commit to green initiatives. And a lot of companies do think it still makes sense. Might that pick up the slack, even if the political environment isn't supportive at this point?
Yeah, listen, clean energy, this revolution is going to continue. There's no question about it. The technologies, the cost curve coming down, this is going to continue. But these policies that the president wants to embrace, and to some degrees Republican Congress, is going to retard that pace of change. And we're in a race right now. Look, we're a race for jobs. We're a race for the climate crisis won't make all our towns burn down in the West, too. We're in a race. We don't want to slow down. We're going to win, but we'd rather win fast rather than slow.
All right, we're going to have to leave it on that note. Jay Inslee, thank you so much. Former governor of the state of Washington 3 terms, and a former member of the U.S. Congress, joining us here on Bloomberg Businessweek. He also leads the Accountability Project at the policy and lobbying group Climate Power.
And safe to say, beloved in the Pacific Northwest.
I love the Pacific Northwest. Having just gone to Seattle in the last year, pretty stunning.
I feel like you spent, 2 or 3 weeks out west just now?
Well, a week.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.